Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van Alstyne. And here is your host, John Aidan Byrne.
Continuing claims for unemployment benefits in America rose to 1.93 million, the highest level in 2 years, according to the latest data. US inflation continues to ease. Personal income and spending is up for October. We'll have more details on this episode of ODEON Capital Conversations. US homeowners saw an average increase of $95,900 in home equity in the past 3 years, but many consumers are not feeling optimistic, with consumer prices up nearly 20% in just over 3 years. Dick Bove says investment banking, from equity offerings to mergers and acquisitions, is experiencing strong growth in most categories. JP Morgan leads in the league tables. Where are US interest rates heading next as talk of rate cuts spread on Wall Street? Dick Bove and Matt Van Alstyne will share their opinions. Harvard University's Joint Center for Housing is under attack from Dick for its latest research on the American housing market, as Dick doubles down on his forecast of a coming housing glut. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van Alstyne, ODEON co-founder and managing partner, and we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
We have some good news on this episode. We have some controversial news or controversial take. Because you're out with a new report, you take another look again at housing. Dick, Harvard has its own study on this, and you take them apart, literally, and you say their analysis is, I guess, flawed. Might be an understatement, but we'll get to that in a moment. Inflation still headed, I believe, in the right direction. PCE numbers came out last week. 3.5% in October, excluding food and energy prices, rose 0.2%. In October. Personal income and spending rose, same for the month of October. Consumers are keeping up with inflation, analysts say, but spending has slowed.
Well, no, what we have is a situation where the economy is bifurcating, if you will. And this is something, idea that we've been introducing in the last couple of podcasts. You know, the people who don't have things still don't have things, and they're still up against, major issues. And when we talk about the economy, we'll point out the fact that just about every segment of the economy from the consumer side is slowing down, even in the service sector. On the other hand, we do have another part of the U.S. economy, financial system, which are people who have a great deal of money. And there's more of them than one would think. Remember, as we said, 1 out of every 15 people in this country is a millionaire. Whether it's from housing or what have you, they are millionaires. They do have the buying power. They do have the ability to use it, and they're using it. And the one area which is almost explosive at the current time is the whole investment banking sector. Now, what is that I'm talking about? I'm talking about mergers and acquisitions between companies. I'm talking about new issues of common stock from new companies or what they call secondary offerings from existing companies. I'm talking about, bond sales. I'm talking about high yield, sales. You're up over 100% on M&A. You're up over 100% on these new issues coming to the equity markets. You're up over 80% in the high yield market. Other than a few areas like leverage loans where the government is really pushing down on the banks, you're up everywhere. So The rich are really getting richer now, and the poor are up against significant issues. But, the vast majority of the population is doing well. And I think that's what is difficult for the Fed to deal with, people like myself to deal with, which is, which way is this thing going to go? Are the people who have the money going to continue to drive the game, or is it the people who are now, dealing with an inability to pay loans? Are they going to drive the game? I tend to think that the latest GDP figures, I mean, a whole bunch of things came out last week, but the latest GDP figures would suggest that everybody's made the decision to buy less, and that's just not good.
They revised the GDP figures up last week,
yes,
the quarter.
Yes. Yeah.
You mentioned something there, Dick. Again, we've covered it a few times. The surge in the millionaire class in America, the 22 million millionaires, and that could be related to home equity values, not necessarily cash in the tiller, as it were. Just looking at this economically, not taking any political stand, you said it's the poorer classes that are struggling.
Yeah, but that's what poor classes do. I mean, having been one of the poor classes for, the first 20 years of my life, I understand, my family came from a welfare situation. I understand the struggle that they have, but that struggle is endemic to being in a poor family. The fact that, that is not the whole population, is getting lost. And the fact is that, the stock market is soaring, and it's soaring because the people who do have, money are able to use it. And even if 100% of the increase in wealth in Americans was home equity, they can still borrow it, and they are borrowing it. And
there's a whole feel-good factor about having your home go up in value. You just feel terrific. Oh my gosh.
Yeah. Well, I mean, in the last 3 years, this Harvard study, which we may get into, over the last 3 years, the average owner of a house has seen an increase in the equity value of that home of $95,000, $95,900, according to Harvard. All right. So the net effect is that money is available.
What was that time period? The $95,000?
$95,900 over the last 3 years. That's Harvard's figure. It's not mine.
$30,000 extra per year, which is average income of what, $60,000 per household. That's 50% extra.
Yeah, it's a huge increase, and it is available for spending. And people do take it down by doing home equity loans. I mean, the home equity loan industry had died. It was dead in 2008. And it did not recover, even up till 2021, 22. It is recovering now because the money is there. People want to do things with that money, and they're using it. But again, the GDP figures for the third quarter, which were just released again, last week, show that right across the board, other than going to restaurants and some tourism, everything's down. Cars are down. Houses are down, all sorts of personal things, whether it's apparel or furnishings, are down. All that stuff, according to the GDP figures, are down. So by down, I don't mean the growth rate is down. The growth rate is down, okay?
The second derivative is down.
Yeah, right.
Prices are increasing at a decreasing rate.
Right, okay. Exactly right, and that's a critical point that you're making.
So prices are still rising in those, but the pace of increases are down.
The pace of increases are down, and the pace of spending is down. When I say down, I don't mean that people are buying less. I mean that the growth rate, if you annualize the growth rate in the quarter, it's below the growth rate year over year, which means there's a slowdown. Although in a number of the consumer categories, goods categories, buying things, they are down in absolute terms.
But Dick and Matt, help me understand something, because a lot of surveys show that a lot of Americans feel real crummy at the moment, and they pin it on inflation, even though inflation is coming down. And on a cumulative basis, since the start of the pandemic, overall prices are up nearly 20%.
The problem is people want the 2019 prices. When you have inflation and you say, okay, milk used to be $2 a gallon, now it's $6 a gallon, and you're not very happy that between 2022 and 2023, it only rose from $5.75 to $6. You want the $2 a gallon. And the problem people don't realize is to get back to $2 a gallon, we're going to have a massive recession. to get back to 2019 prices, you're going to have a massive recession. It's not happening. Prices are, inflation only goes one direction. And if it starts going the other direction, then you have a depression. A deflationary environment is less healthy than an inflationary environment. And so, I've always kind of taken issue with the goal of 2% inflation, because that means your money loses half its value over like a 40-year period. Like, they should have a target of 0% inflation, but they can't, because when I say they, the elite class, the class that gets elected, the people that run things, you have to have that psychological benefit that you're getting further ahead in life. And it makes you feel good that, like, my parents bought their house, back in the early 80s for 80 grand, and now it's worth almost 800 grand. And it makes you feel like you really made a really solid investment. But the truth is, you have to measure it against other factors like GDP and income. And I would bet that their house is probably kind of on par with GDP. But it gives you that psychological benefit targeting a 2% inflation. And I kind of wish the Fed targeted 0%.
Dick, just in historical reference here, you mentioned about the poor in America, but that's the beauty maybe of the American dream. People in the past and to this day come to America poor, and then eventually they become middle class, right? So nobody disparages the poor. It's a state of being.
Yeah, exactly. And the bottom line is, even though you see these articles being written that people think that their children will never get what they've gotten, those articles were written 30 years ago, 50 years ago, 70 years ago, because I was around to read them. So the point that I'm making is that every generation argues that the generation behind them is not going to do as well as they've done. And there's no evidence of that whatsoever ever in the United States, in post-World War II times. And I don't think there's any evidence that it's going to happen, in this generation either. I think that young people don't have money. Big surprise. Poor people don't have money. Big surprise, right? The point is that the U.S. economy is moving up at a slower rate. The U.S. economy is composed of very wealthy people as well as very poor people, and the mix is generally very, very positive.
Well, we have nearly 10 million job openings in America, even though the unemployment claims are rising. So anybody that wants to find a job, by that logic, can find a job, or does it work like that? Because regional differences, obviously.
Yeah, I don't believe those numbers at all. I absolutely think that those are the falsest numbers that the government puts out, because I think corporations are hoarding labor, and corporations are saying they want to hire all these people. But, you go tell your kid to go find a job, and they'll find that basically, number one, you can't talk to anybody. In other words, this whole concept of you go into the company and say, can I talk to the manager? I'm looking for a job. They'll say, get on the internet. So now you get on the internet and you've got all of these systems that are set up, by the employers, in which they automatically get rid of, large classes of people for whatever reasons they put into their job search situation. But the fact of the matter is that these JOLTS numbers, which is the job opening numbers, I think are probably the biggest farce out there. Companies are not hiring people. Companies don't want to hire people, and companies are starting to fire people. Spotify this morning indicated for the third time this year that they're, getting rid of people. I like to keep my eye on the unemployment claims number as the only really valid number concerning the job market, and the unemployment claims number is edging higher.
I'm sorry, but when you say the JOLTS numbers, one of my favorite things is when you rip on the authoritative numbers that we see, because I don't think there's a number you like. I'd love to know what number you do trust, because it seems like everyone is tied for the worst. I'm questioning, are you saying that the JOLTS number is fabricated, or are they doing an accurate count and it's more of companies advertising excessive for more jobs than they're actually intending on hiring, with the hopes of capturing labor while they can? And so the number is just massively inflated, not fabricated.
Right. The latter. In other words, obviously the government is collecting the numbers from people, from companies that are giving the numbers to the government. So the government is not fabricating anything. The companies are, want to show that they're always open, for hiring, because they want to make sure that they have an open access to the job market. So in my view, they put in, indications that they're willing to hire this, that, or the other thing, when they're really not. but they're open, they're in the area, and if it all of a sudden a whole bunch of people quit on them, or something goes wrong, they have the ability to ramp up that system and to interview more people and get more people in. But I'm telling you, if there are young people in your family in the 20 to 30 age category that are looking for jobs, there aren't a whole bunch of people, a whole bunch of companies out there willing to hire. And the whole hiring process has become totally impersonal, totally AI, if you will. And essentially, if your resume doesn't fit into, whatever the AI construct of the company is, it just gets tossed out and you're not even looked at. So the whole process of hiring people is broken down.
Let me tell you about it from the other side. I'm sorry. When you post an ad for anything, for any type of non-specialist job, you're inundated with, if you use any of the websites, hiring websites, you're inundated with hundreds, if not thousands of resumes that are totally inapplicable. Yeah. Yet they get coded to you, because what people do is they'll take keywords that employers like to hire for, and they'll hide them in their resume, and change the font color from black to white so that they get picked up by the AI, but it's, skipped over by the human reader. And so you get all these people that are pegged by AI. I don't know what it is, but the, Indeed job board says, oh, this candidate's 100% match, but they're actually a 0% match. And so you get inundated with useless resumes. So I think it goes both ways. Like it's not just that the companies are trying to filter, the job candidates are also trying to filter and game the system. So hiring is really hard right now. And it's gone to word of mouth and networking, which I guess is the old fashioned way and probably the best way.
Depends on the industry, Matt, because I know in the Northeast, maybe in Florida, it's different, Dick. You can't find young school-age kids to take up a trade. I mean, there's shortages of electricians, plumbers, carpenters, and even in the IT sector, it's hard to hire qualified or suitable candidates. So I think it's a mixed picture, Dick.
I think what Matt said is exactly correct. The system is flawed. It's flawed on both sides. Fortunately, this firm is hiring, but the point is that actually is hiring. But the point is that basically, since the system has moved away from person-to-person interaction to a computerized mechanization, the system doesn't work. In my view, it's flawed, and therefore I don't like the JOLTS numbers. I do like the unemployment numbers. I think they are a valid indicator of what is going on in the economy, and they're not showing that the economy is rolling over and falling apart. They're showing a modest, gradual increase in unemployed people seeking jobs. If that turns into be something more than a modest increase, I'll pay very close attention to it. At the moment, I'm just keeping my eye on it, but I do believe in those numbers.
The continuing unemployment claims surged to 1.93 million in the latest data, and that's up nearly 90,000, the highest since November 27th, 2021. So continuing unemployment claims are rising.
Yeah, they jumped more than I think I've ever seen it. Obviously, they jumped more at some point in the past. I haven't seen everything, but last week it was a huge jump. It was an unexpectedly huge jump. So what I use is the 4-week moving average of seasonally adjusted numbers, and that indicator seems to be, well, I know that everybody else uses it as a precursor of the economy, not something following the economy. So I think that number is reasonable. That particular number did jump very big last week. There's no question about that.
I want to go back, Dick, to your investment banking boom report. So that's one of those bright lights in our economy at the moment. I guess we don't want to over-exaggerate, but in 2020, during COVID, corporate mergers, equity raises and debt underwriting surged and then hit a record in 2021, then plummeted it plummeted just later, and but now it's on the rebound.
Yeah, in other words, what I do, I mean, there's this Bloomberg system out there for the financial industry. It's better than anything that ever anyone could conceive, and it exists. So it's very good. So what I do is I take a look at what they call the league tables for a variety of different types of financial instruments. It starts off with investment grade. It goes to high yield. It goes to leverage loans. It goes to, these things in different areas of the world. It goes to, it shows you equity offerings, mergers and acquisitions, you name it, it's in there. And what I do in the second month of each, when the second month of each quarter ends, I look at all those numbers to see, should I be saying that bank earnings are going to be good this quarter, or they're not going to be good this quarter? And I was just blown away with what I saw, a couple of days ago, because the numbers were bigger than anything I've seen in 2 years. It's right across, as I say, other than leverage loans, which is a function of all these new government regulations, we're seeing just huge increases in activity. Company wants to go public, this is the time to do it. A high yield company wants to grab money for, a less than normal proposal, this is the time to do it. The money is there. All this stuff about how the world is changing because increase of interest rates, change in money availability, which is driving M&A. Again, bango, it is happening. And there's a whole bunch of companies which are set up to handle that. Obviously the Goldman Sachs's, the Morgan Stanley's, the Bank of America's, the Citigroups, they're there handling it. But there's a second class of companies that spend all their time doing this. Companies like Lazard, Moelis, and other companies of that ilk. And they're all seeing this tremendous benefit, which is occurring right now. Now, why is it happening? It's happening because there's a huge amount of money around that we keep talking about, that $7.5 trillion that was printed. B, confidence on the part of CEOs is increased dramatically now that everybody claims what the Fed claims that they're not going to do, but everybody claims that, the interest rates are going to be cut, once, twice, 5 times next year, starting in March, April, second half, what have you. So, you've got these companies have got the money. It's there in terms of the need for utilizing that money. They're utilizing it in the marketplace. The banks have not been able to provide the funds that the economy needs at this moment because of this huge change in regulation that we talk about all the time. So the capital markets industry is just experiencing one of the best quarters in its history. And that'll show up in the earnings when they produce them in the middle of January. Generally, they start producing them around January 15th. But if you're looking at Goldman Sachs, Morgan Stanley, be surprised. Be aware that you're going to be surprised on the upside. If you're looking at, JP Morgan, if you're looking at Bank of America, you're going to be surprised on the upside because these numbers are phenomenally good.
Your tables show that JP Morgan Chase is clearly the outstanding leader. Bank of America follows next. Citigroup doing well. Wells Fargo struggling. Goldman Sachs not doing well. Morgan Stanley is falling behind.
Yeah, in other words, what is evident is that the banks, if you notice all the things at the top of that list of banks, the ones a little bit below that are broker dealers, we'll call them investment banks. The banks have this excess money that they're not putting into loans so that they are getting their clients to do things in the marketplace. And the banks are benefiting from it. JP Morgan, when you go through these league tables on Bloomberg, what you see is that JP Morgan is number one in virtually every category. I mean, and they weren't number one a year ago in every category. I mean, they are so good at what they do, and they keep getting stronger and stronger and better at it, that, it's showing up again in these numbers. Bank of America, which had been focusing so much on, the consumer and bringing in retail deposits, all of a sudden, they own Merrill Lynch, right? All of a sudden, about 6 months ago, they must have figured out that the consumer is taking his money and putting it somewhere else, not in Bank of America, and they refocused on Merrill Lynch, and Merrill Lynch is explosive. Citigroup, it's made the decision that, it doesn't want to do business with everybody anymore. It doesn't want to do business with the mass market anymore. And they've restructured. They're firing people left and right, in those areas, and they're hiring in the areas where they want to be. They've restructured so that they're doing well. Wells Fargo, is starting from a major hole. They weren't ever in these businesses in a major way, and they're trying to buy their way in, and it's not clear whether they're succeeding or not. Goldman Sachs is really a shocker. because maybe this internal change in people did affect their business, but it's showing up. And Morgan Stanley has shifted emphasis to asset management and away from investment banking, and therefore they got to play catch up right here. But all of them are going to do better than we think.
I'm wondering, though, you've said that the Fed is shrinking its balance sheet and it's down by over 1 trillion. So how does that play out in investment banking and in just wider Wall Street activities? Could that be a negative?
When I listen to people make the next statement I'm going to make, it always annoys me, but that is really an excellent question. Okay. So the fact of the matter is that
I take a victory lap here.
That is the contrafact. The contrafact is that money supply is shrinking. The Fed, even though everybody says it's going to do all these things next year, the Fed itself says it isn't going to do those things next year, and the Fed is not showing any signs of, changing policy whatsoever.
When, pray tell, has the Fed been accurate about its predictions 12 months out about itself and its own behavior?
Never. Okay, never. All right. But the fact of the matter is, for the last 2 years, everybody is saying the Fed won't do what the Fed is doing, and they're doing it. So I'm not going to tell you the Fed predicts the future well, because it doesn't. And it doesn't because it's not a rules-based Fed the way Milton Friedman would have argued it should be. It's a data collection Fed, which I think is the absolute wrong way to go. But anyway, they haven't blinked. They haven't reduced what they're doing. And ultimately, if you have a monitor is spent, and I actually listened to a professor from Stanford who's just written a book on Milton Friedman, which has just came out, and I was able to listen to her do a question and answer session for an hour about Milton Friedman and about money supply and all this other stuff. So I do believe that ultimately, if the Fed doesn't stop tightening, it is going to impact the economy very negatively, and unfortunately, they have not stopped tightening. But right now, that money
paused.
Yeah, they paused in interest rates, but they haven't paused in shrinking, the balance sheet. They shrunk it by $77 billion in the month of November. They shrunk it by $16 billion last week. So they haven't paused, in that regard. And I happen to think that's far more important than what they do with interest rates. We'll see. But right now, money is around, money is flowing, investment banking is doing extremely well, and the Fed is pushing against it.
We should slip it in, even though we mention it on every episode. Interest rates, is this pause for good? There may be one more rate hike, Dick. You said there might be one token one, but that's it.
I'm not even sure they'll do the token one now. The point that I think is relevant is they're finished in terms of putting increased tightening in. Now, the fact that there's a whole bunch of ways to look at that. You can say they're finished, and therefore the next move has got to be that they're going to ease, right? That's a logical assumption. If it takes them a year to ease, and in that year you run into a recession, then you got to be thinking differently than the market does now, which is that they will ease immediately. Bill Ackman, a very successful money manager, a very incredibly bright guy, says that they're going to ease in March. Other people have jumped in and said, no, it's going to be in May. And the Fed is saying, no, we're not going to do it in March or May. So,
I'm sorry. Are these, I feel like everyone who's predicting this stuff is just smoking hopium. I mean, the idea that, I'm sorry, the reality is if the Fed commences the easing cycle voluntarily, preemptively, because they think that they've gone far enough and they want to engineer the soft landing, that is phenomenal news. That's just amazing. That would be just the most ridiculous, crazy, awesome news you could hear. Because the reality is what happens when the yield curve inverts historically is it stops inverting and it reverts to the norm. And if it reverts to its norm because of economic slowdown, the front end of the curve gets clobbered, and the Fed has to react to that. And then the Fed cuts rates, which is historically what happens. Or inflation gets out of control and the long end goes up because people are ditching their 30-year treasuries in face of inflation. And so the yield curve inverts, shows that the recession is coming because the reversion to mean is either recession is happening on the front end or massive inflation is happening on the long end. and whatever the Fed is doing is reacting. So the idea that they're going to cut preemptively in March or May because they've decided this is the time, that is the best case strategy, because the more realistic situation is somewhere along the line, we hit a road bump. Somewhere along the line, something bad happens and they have to cut drastically. Dick hasn't talked about it for a while, but he used to talk about the reverse repo market. And I don't know if he's been paying attention. I'm not trying to spring this on you, but the reverse repo market hit its peak, I believe, in March or April with around 2.5 trillion. And right now, I think it's in the 700 billion range.
Yep.
The money's fleeing the system. If that gets down to zero, you're going to see the Fed cutting faster than anyone expected, in my opinion.
Yeah, no, I think what you said, everybody should really listen to and understand fully, because that's exactly what I believe. But the market is flying right now. All right. And because it's flying right now, you have to ask, why is it doing that? And the answer is these pundits that come out and keep saying that the Fed is going to cut. It's going to cut, anywhere from 1 to 5 times, in 2024, and it's going to begin in March. Now, I happen to think that it's ridiculous to say that. I happen to believe exactly what you said. That's what I believe. The reverse repo market is a tremendous indicator of what's going on right now, because every time that the Fed cuts the size of its balance sheet, it's paying down reverse repos. And it's, I think, knocked them down by $700 billion. I forget the exact number. But the point is that, that you're exactly right. That's what you should be focusing on. That's where the if you will, what do you call a point of truth is, because in that reverse repo market, you're seeing what the Fed really believes, what it wants to do, and they are just getting rid of repos, reverse repos as fast as they can. I mean, we wrote a piece about 10 days ago saying happy days at the Fed. Now, the reason why we said it's happy days at the Fed is because, number one, with interest rates higher, all of the mortgages and long-term treasuries they bought are going up in price, so that their negative equity is decreasing. Number two, they're starting to take that advantage in reversing the size of the reverse repos, which is the short-term money, right? So that their cost of funding is actually going down. Another very big positive for them, because it means they're going to stop losing money every quarter. And number three, to the degree that they continue to shrink and shift where the money is coming from, in other words, they go back to getting it from printing currency and getting it from the banks and the Treasury. The Fed is now on a very solid standing into which it can grow its balance sheet. So, everything that the Fed would want to happen to make things better for the Fed is happening. And that's why we wrote this piece called Happy Days for the Fed. And I think your point about the reverse repo market is critical. That's the thing I watch most every week. What is happening to reverse repos? And every week the Fed is paying them down, paying them off. And that's
is that the right phraseology though? Like, it's not the Fed's choice, because it's a reverse repo, which means the banks who have cash are planting it at the Fed for that extra 5 basis points, I believe, because it's more attractive than treasuries. And the fact that they are pulling that money now, I'd love to be corrected if I'm wrong, but to me that means that consumers and businesses and everyone that used to have money at bank accounts is now moving that money from bank accounts, possibly just buying treasuries themselves. But it seems like liquidity is leaving the system, and it's not the Fed's decision that this is happening. It's just a byproduct of their other decisions.
It's their decision in the sense that they don't have to let it happen. They don't have to.
Yeah, they could make it more attractive.
Right. Yeah. And in addition to which, they could, continue to borrow money themselves, which they're not doing. And that's the whole point. They are taking liquidity out of the system. So, you got the market here, which is saying there's going to be more liquidity in the system at lower rates. And therefore, the market in November went up. I don't know. People have numbers, it's like 9%, and they have numbers saying that you're going to go back 5, 6, 7 years before it happened, the last time it happened. But anyway, there is a belief on the part of investors that hallelujah time is here, that, the Fed is going to cut, is going to walk away. My belief is what you just said, that they're not going to do that. And therefore, I think that, there's going to be a period of problem for the market when they begin to realize that the Fed is not going to walk away.
So happy days are here again at the Fed. I'm thinking of, there was
Used to be a show on I think it was the Fonz. Was that
Yeah,
his
that's
theme
right.
song?
Happy Days. Henry Winkler.
Harvard University has a joint centre for housing, and they publish a lot of data and research on housing, Dick. And you recently had your own numbers and ongoing research on the demographics of America and the needs of housing. We're overbuilding, or there's going to be a glut developing. That's what you anticipate. And so you sort of tear into Harvard, their latest studies. You say that, first of all, you question their independence because they're being funded seemingly by outside housing interests. So that would put an inherent bias on some level. The results of the Harvard studies is an academic mess, to use your words, which Harvard should be ashamed of. And you also say, not surprisingly, the study argues repeatedly that more housing in America is needed. And you say the exact opposite.
Before I go into the rationale for attacking Harvard here, which I think is, should be thoroughly embarrassed by what it's doing here, because when you look at the second page of the study, they list all of the contributors to, the Harvard Center for, domestic, whatever they call it, housing. And there isn't a lobbyist group in the United States, that is lobbying for more housing and more, money from the government to support low income housing that's missing on that page. I mean, if they ever use normal print size, they would have to use 2 pages to put all of these, people who put the money in instead of just 1 page. Before discussing my problem with, there was, again, last week all these reports came out. The Census Bureau revised its 2017 projections for the population. And they came out with their official 2023 projections for, population. And so I took out both studies, and I compared the numbers, and, they were unbelievable. The first off, the 2017 study indicated that by 2023, we would have 4 million people more than we actually have. In other words, the study in 2017 claimed we would get to, I think, 359 million, or with 355 million, something like that. But the point is that, they were dead wrong. They were off by 4 million. But that's not the big issue. The big issue is that the 2017 study claimed that we would have 404 million people in the population by 2050. The study they put out for 2023 says we won't even have 400 million people by the year 2100. We won't even have, in 2100, the amount of people that the 2017 study said would have in 2050. In other words, they're saying that we're only going to add something like 5 million people to the population, between 2050 and 2100. Now, what I'm saying is, it sounds complicated, but it's simple. They have over-predicted the size of the population massively in the 2017 study that the Census Bureau put out. They've corrected those numbers today, and they've taken them down by a staggering number. Something like 40 million people, right? So now, why is that happening? What caused the difference? What caused the difference is that people will be dying faster than they'll be being born, starting in the year 2038. But, forget 2038. Every year between now and 2038, births are getting less and less relative to deaths. And then the thing flips in 2038, in which deaths get bigger and bigger as a relate of birth, and by 2100, if they're correct, there's 1.2 million deaths more than births in the United States. So then the study comes to the conclusion that if you want to see population growth, it's got to come from immigration. And then they make 3 assumptions as to what immigration is going to be going forward, all of which says that they don't have a clue what immigration is going forward, but at least they know what immigration is up to this point, whether they're coming across the border in the Rio Grande River, or they're coming in legally. We now have a decent number as to what the population is relative to immigration. Harvard knows these numbers. Harvard, in this study that I'm criticizing, knows what is happening to the population numbers. So the second step you have to look at is, okay, let's take a look at these population numbers and take a look at the number of houses that we have and how fast we're building them. Even though Harvard says, we need all these houses, they're admitting that there are fewer persons per household than ever before in the history of the numbers. All right, it's now to 2.51 people per household. So they know that. They publish, the indications in this report that they know that. No, they don't come to the conclusion that maybe we're building houses too fast relative to the size of the population. They forget all this stuff. They're the ones who said that the home equity values went up 95,900. They throw all this stuff aside. They throw aside the stuff that, incomes are growing faster than inflation, which is Matt's point that I was wrong on about a year ago. They put all that stuff in the garbage bin. They put everything in the garbage bin related to what's happening with the population, and they say, the poor people need more houses. Well, of course they need more houses. I remember having to move into my uncle's house because my parents couldn't afford, where we were living. I mean, the fact of the matter is that happens to poor people. All right. It does not happen to the American population the way it is now. The Harvard study complains that they're not building enough houses below 1,800 square feet. So not only are they ignoring the fact that we've got fewer persons per household, but the households are bigger. So now, the question is, well, what is it like anywhere else in the world? And you find three categories of countries. You get, on one end, the countries which are losing population, Japan, South Korea. They have fewer people per household than we do. Then on the other side, you got the wealthy companies, Sweden, Finland, etc., and they have fewer people per household than we do. But in the middle, you've got India and China, and you've got the rest of the world. And whereas we're at 2.51, if you take the average of all these countries, they're at 4.9. So the rest of the world doesn't live in bigger houses with fewer people. The United States does. My question is, how long can this go on? How long can you keep building houses at a rate faster than population growth, which we've been doing for 58 years now? How long can you do that without running into a situation where you have too many houses? And what really frustrates me about the Harvard study is they have all the same numbers that I do. Their numbers are in their report, just the way mine is, in the report that I wrote, but they just refuse to look at the whole population, and they focus on the government's got to help the poor people, which will give us the opportunity to build more houses subsidized by the government, to sell more houses subsidized by the government. They're making this push that the taxpayer should come up with more money to build maybe something that we don't need, as opposed to looking at the whole population and saying, gee, these population numbers relative to these housing numbers don't fit. And they don't fit relative to anywhere else in the world where there is large populations. And that's my song and dance.
There's something missing. And when you go through the whole thing you went through with all those numbers, I am like, okay, I'm starting to agree with you. I don't believe the numbers because everything in the data seems to indicate a shortage of housing. House prices continue to rise. I know new home sales prices have been dropping, but that's largely because they've been dropping the square footage of the houses because the price per square foot has not dropped. But, just last week, I think it was, we got another, looking at it right now, the S&P composite house price changed 3.2%, went up, and we're supposedly in a situation where there's a glut of housing. The other number I disagree with is this population number. And I've mentioned it a few times, but, I sometimes listen to Fox News and sometimes I read, the reports out of the New York Times, and they talk about 200 to 300,000 people coming in across the border every month. And yet the population only rises in the official census estimate, by less than that. And I'm like, okay, so I don't know. We've mentioned this a few times. I'm going to actually dive into it this week. Do illegal immigrants count in the census? Because if they do, then I don't trust the census numbers. And if they don't, then you have a big gap in your data. But it sure seems like something else is happening.
According to census data, they measure, they say, the residents in the United States, and residents could be anybody who's physically present.
It should be
at the time of the of the census. I just want to bring up something, Dick. You've really interesting numbers and very extensive and comprehensive. But my challenge in buying your thesis is that there are so many regional differences. I mean, it's almost impossible to know where to begin or end. There's ghost towns in America. Towns come and go. Detroit rise and fall. Hundreds and thousands of houses disappear. You go up to upstate New York, Catskills, go through some towns there. They're in decay. The houses are still standing. They exist in the housing unit stock. So new houses will be built. We may have an oversupply, but in theory or in practice, there's still a functioning housing market. It doesn't mean there's a glut.
Another great question. Okay. Okay. What I've done is, and by the way, from Matt's point, I can't defend that the Census Bureau is counting the people right or wrong. I don't know whether they are or they are not. I do know that they now are putting immigration in the numbers at right front and up front. And therefore, I take their number because I can't take any other number. In terms of what you're saying, John, if you go to Michigan, in Detroit and even in Ann Arbor, which is not a city in difficulty, they're bulldozing houses because they don't want the city to look like a dead zone, and they're putting parks in places where the cities were. If you go to your regions of the country, Maine, New Hampshire, Vermont, they've got 20%, 21% of the houses in those states are empty. All right. So you'd say, okay, these areas of the country are not growing as rapidly. These areas are in trouble. But you then come to the question of which city in the country has the greatest amount of empty housing, and you won't guess it. It's just impossible for you to guess it. It's Orlando, Florida. 160,000 empty houses in Orlando, Florida. But Orlando, Florida is the place where everybody's moving toward. Everybody's moving into Florida. Supposedly. Anyway, so, supposedly, there's 800 people a day that move into Florida, and yet there's 150,000 empty houses in Orlando, Florida.
When you say empty, though, I mean, I have friends that have second homes in Orlando. I mean, does that count as an empty house?
No, that's not. According to what it's no different. In other words, they're comparing Gary, Indiana, where there's apparently some 20% of the houses are empty. The fact is that, they're comparing the two towns, and they're saying that this is what it is in Orlando, this is what it is in Gary, Indiana, which I think is 21,000 in Gary, Indiana. We get to this problem that these statistics are always put out, and you don't know how valid they are, and you don't know how well they're constructed, and if they're considering all of the variabilities, but those are the numbers. They are what they are. And the fact of the matter is that we're in an inflationary economy. We have a massive amount of money, which we're drying up, as quickly as the Fed can do it. But we have a massive amount of money sitting out there. Housing has been a beneficiary of it. And therefore, again, if what the census numbers say are correct, and again, you might say they're not correct, but if they're correct and they are looking at immigration very closely, we are building too many houses for the growth in the population. Now, that's been true for, this started, the numbers started in 1959, and from 1959 to the present time, we've been building houses faster than we've been adding people. So, on a percentage basis, not on an absolute basis, on a percentage basis, it has to end at some point. At some point, it's going to end. Now, is it going to be 2024, or is it going to be 2038? When the birth-death thing rolls older, I don't know. All I know is that there's no other country in the world, of size. Forget the little ones. There's no other country in the world of size that have this many people living in this larger living space that, one can say that the United States is well within the mean. Again, if you take Sweden, which is a small country, it's 2.1 persons per household. If you take Japan, where the population is declining, I think it's 2.25. If you look at the United States, it's 2.51. But China is 2.70. India is 4.85. I ran into a real problem with the United Nations data because I went looking for, the data to the United Nations, and they said that I wasn't authorized to take a look at it, so I couldn't get it. But then there were other people who did get that information that published it, Wikipedia being the best one. It's amazing. This country, people are wealthy. They're living well. They've got nice houses. They got huge profits in those houses. Whether that's going to continue forever, one would hope so.
I'm sorry, I'm no one's a bigger fan of Harvard than I am, but this feels like one of those things like if you can't do, teach. I mean, if you go back and look at the National Association of Realtors, going back to like the early 80s, on average, there's more usually at any point in time 2 to 2.5 million houses for sale. And right now we're tipping around 1 million. It's an all-time low. Like if there's a glut of houses, there would be a glut of inventory, but there isn't. And we've discussed my theoretical reasons behind it, but going back to this Harvard study, it just sounds like it's a bunch of people living in an ivory tower looking at statistics, and they've never actually stepped out foot into the real world, and they're using statistics from some theoretical location rather than reality, because the reality is it's hard to buy a house right now because there's so little inventory, not to mention the mortgage rates and all the other reasons, but the inventory is at an all-time low, and it's not because we have a glut of housing.
To add to that, Silo earlier this year said Americans seeking to move out on their own outnumber available housing by almost 2 to 1. That was in 2021.
Yeah, but unfortunately, I don't use, by the way, the National Association of Home Builders is one of the biggest contributors to the Harvard study. But anyway, the fact is that, so they're fully in line with the Harvard study. But
no, National Association of Realtors, I'm not sure if that's different.
Both of them are.
Okay.
Both. In other words,
the one I'm looking at right now is National Association of Realtors, not Home Builders.
Yeah, but if you go to page 2 of that Harvard study, you'll see there's about 17 or 18, real estate functionaries or lobbyist groups that are funding the study. And both the NAHB and the NAR are in it. Again, the numbers, in terms of all of the things you would look at the demand side would argue that you guys are right. And I'm way out in left field in terms of this, but I'm not using the numbers that Harvard comes up with. The government comes up with these numbers. They come up with the employment numbers. They come up with the population numbers. They come up with the number of houses in existence numbers. In fact, one of your partners here at the firm, wanted me to give him some more hard numbers. And then when I gave it to him, the issue kind of went away, because the vacancy statistics are one of the best places to go to see what the housing stock is and how it's utilized. And that's published by the government. Those are the numbers I use. Harvard has those numbers. They don't focus on them. They focus on the numbers that you mentioned, which is that, mortgage. They got this mortgage rate thing. It really drives me nuts, because the average mortgage rate in the United States, going back to 1971, when the Federal Home Loan Mortgage Corporation started publishing it, is slightly under 8%. It's in the 7.9% range, right? The mortgage rate right now is 7.07%. That's not a record rate. That's not even close. A good 10% below, the rate that people on average have been putting on their mortgages, going back, for 55 years, 53 years. So the bottom line is all those numbers argue that I'm wrong. All right. I'm hanging in with population versus housing production, and we'll see.
So if there is a housing glut, that means serious consequences for some investors and for the housing industry, because we know we had a subprime mortgage crisis some years ago. We don't want a repeat of anything of that scale. No,
well, you're right. I mean, it will create a significant crisis, because that's where the wealth of the United States, homeowner household is. It's in those houses, and if all of a sudden those houses start coming down in value, they can't borrow against that equity.
I would point out, is two things can be true at the same time. You can have inflation and housing inflation while having a glut, because housing can decrease in price relative to inflation while still increasing in price. And that type of situation, you wouldn't have the financial crisis, because you wouldn't have underwater houses and other things, underwater mortgages and things like that. So both things can be true. You can have housing prices go down relative to the general economy while having inflation.
Basically, it's something that back in 2000, 2006, I went way out on a limb, saying that the housing industry was in a bubble and it would crash. And it took a year for that prediction to be correct, but it was correct for exactly the reasons we laid out at the time, which is that the structure of the mortgage industry had evaporated. In other words, we were doing modified mortgages, and first 3 years you pay 1%, and then in the fourth year you pay a market rate, et cetera. So we're going out on a limb again. right now, going against all the statistics, which would argue that housing is needed, that poor people can't get houses, people want to move out and they can't move out, all of which verbiage I don't agree with because none of the statistics support it. In other words, the reason why there's so few people per household in the United States is because people have moved out. In other words, old people do not have to live with their children anymore. The United Nations put out a study which shows that in the United States, only 4% of the households are composed of 3-generational families. Myself, my daughter, and my grandchildren. Only 1 out of every 25 houses are in that condition. That was not the case 50 years ago, right? So the point is, if people are moving out, older people can live on their own, younger people are finding places to live. Otherwise, this 2.51 number would not exist. And the way I try to prove that is in 1940, I took a look at the number of people per family, and I compared it to the number of people per household. The numbers were within 0.09 of each other. They were so close. They were just overlapping. When you look at the numbers today, the differential is around 1%. In other words, the families are not declining that rapidly in the number of people per household. They're staying pretty much where they were. What is declining is the number of people per household, not number of people per family. So what does that tell you? It tells you people have moved out, and they've moved out in the millions, right? So all these articles about the fact that this is not happening absolutely does not square with the statistic.
We always regard Germany as the locomotive of the European Union and of Europe. US home ownership rate here is 66%, and in Germany it's 46.7%. It's really a sidebar, obviously, to our discussion, but it's an interesting context that
the reason is you can't get a 30-year fixed rate mortgage in Germany. All right. In other words, you've got to work. You've got to have a higher down payment in order to get any type of loan, but you're not going to get a 30-year fixed rate payment. The only country in the world that I'm aware of that will allow you to get a 30-year fixed rate mortgage similar to the United States is Singapore. But, and that's not such a sizable country. So everywhere in Europe, if you go looking for a 30-year, you can't get one in Canada, right? You can't get one in Mexico. Only in the United States can you get this product. Only in the United States do you have Social Security payments, which are so high that older people can live on their own. This is a very special country. It has very special benefits for the people who live here, and housing is one of them. I just think that there's got to be a limit at some point.
You're here to that. This is a great country. Let's keep it that way.
God bless America. Literally. Dick and Matt, we're out of time. We've had a very long and interesting discussion, and we'll come back to this notion of the housing glut, Dick, and interest rates and the economy, banks, and lots more on episode 99, one away from episode 100. And until then, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.